Yeah, so today's video is going to be about daily buyers. It's going to be about how to find daily buyers. When it comes to ICT, what we use to find daily buyers is internal range liquidity and external range liquidity. In basic terms, what we are trying to say is that the markets raise liquidity, right? And then it balances imbalance. When we talk about imbalance, let's say there is a fair value gap over here. If we have a fair value gap this way, and then there is a space between the first and the last candle, then that is a fair value gap. And the algorithm will read price back to it, right? To balance that fair value gap. Do you get it? And after doing that, it will rate liquidity. We talk about rate liquidity. Those are swing highs and swing lows in the market, right? So if the algorithm sees that there is a fair value gap over here, then the algorithm will do what? Will read price to that fair value gap, and then it will come back to rate liquidity. And after that, let's say there is a fair value gap here, the algorithm will come back to that fair value gap again, and then it will continue. Do you get it? So price is always doing two things. And the two things price is always doing is that it raises liquidity, then it balances imbalance or fair value gap. So that's what you should put it in your mind. And fair value gaps are known as internal range liquidity. And liquidity points known as swing highs and swing lows are known as external range liquidity. Do you get it? So the first step to finding daily buyers, right, is to find out the overall trend of the market, right? And you can start from the weekly time frame and come to the daily time frame, or you can start from the daily time frame and go down to the 4-hour time frame. Time is fractal, right? When we talk about time is fractal, it means that whatever you can apply on the daily time frame can be applied on the weekly time frame, can be applied on the monthly time frame, can be applied to the 4-hour time frame. So the advice I always give to my students is that whenever you are starting buyers, you first start from the weekly time frame. If the weekly time frame isn't clear, then you move to the daily time frame, because here you can clearly see that the weekly time frame isn't clear. We took external range liquidity over here, and I just don't know what we are. Price is consolidating. You see how price is moving over here? That is a consolidated price action. So whenever you are confused, you go to the daily time frame. And when you go to the daily time frame and you are confused, then you stop trading. You should take note of this. Do you get it? Because in trading, our main goal is to protect our money. Do you get it? So we go to the daily time frame, right? And on the daily time frame, what do we see? On the daily time frame, we can clearly see, right? We want to find out what is happening to the current price action. That should be your focus. What is happening to the current price action? So we can clearly see that here on the daily time frame, we can clearly see that we're in a downtrend, right? And even apart from the market showing us that it's the downtrend, we can also see that in a downtrend, up close candles, right? Also known as CISD, right? Bearish CISD. So you could see that when we talk about CISD, also known as change in state of delivery, you could see that we had a CISD over here. And then you can clearly see this. This is not really a CISD, but one rule of thumb is that in a bearish trend, up close candles will be supported by. So this is an up close candle. You can see how it supported price to go down, right? And even if we are to even put that one aside, we can also see that bearish PDRs will be supporting price, right? So price will be respecting bearish PDRs and disrespecting bullish PDRs, right? So when you see those kind of signatures, that should tell you that the market is the bearish trend, right? So you could see here we had a bullish fair value gap, but it got disrespected. You get it? Yes. So now let's look at what happened to the current price, right? You can clearly see that the market took this external range liquidity, and then it went for this internal range liquidity. Now that the market is reacting to this internal range liquidity, we want our next target to be this external range liquidity, right? So one thing I always advise my students is that whenever you are bearish this way, right, and then you spot a bullish fair value gap, you see there is a bullish fair value gap over here. That can affect, this bullish fair value gap can affect the movement of price. So whenever you are bearish and then you spot a bullish fair value gap that can disrupt the movement of price, then you should target that, or you should wait for the market to fully disrespect that before you look to continue on trading, right? Another thing that you have to put it in your mind is that this is when we start trading from an external range liquidity or an internal range liquidity. So in this example, price took this external range liquidity and wait for this internal range liquidity. Now we want to target external range liquidity, right? But before we start trading away from this FEG, we want to see this price signature, right? You want to see this being our first candle. This is what C-Trade will say, your C1 candle, right? And then we want to see this being our C1. And we want to see C2, which is also known as the reversal candle, to take the C1 and close inside the range, right? So you want to see something like this, right? So when you get this signature, that is price telling you that it wants to go lower. And that is the reason why it is closing inside the range of the first candle, right? If you really want to understand that, or to understand the idea behind why we are saying this, then let's take a look at basic candle closures, right? We are just taking a look, right? Just a random look, right? We are not going to apply PDRs or anything like that, right? So let's just take a look. When you come to the market, right, that is a basic rule. Just focus on the rule. When you come to the market and you realize that we had this previous candle and our current candle is closing over that previous candle, then automatically that is the market telling you that it wants to go lower. And that is why it closed over the previous candle. So the next day, you can say that the market is likely to come for this previous daily low. So let's see what will happen. You could see that we came to that. And as long as we are closing over this way, and we talk about closing over, you can see we closed over with a belly. That should tell you that the next day the market is likely to come for this low, right? So let's see that. So we could see that the next day it came for that low. Now let's look at this. When the market came for this low, what is happening? We could see that it failed to close over. Instead, it closed inside, right? If I'm to zoom out, this is a bearish candle, right? So it opened, printed a high, and then went lower and then closed. You see, it closed inside, right? So if the market is doing this, then that is the market telling you that it's likely to go bullish the next day. That is why it chose to close inside, right? So the next day the market is likely to go up. So let's see. So we could see that this didn't really go up. It consolidated because it is stuck between the candle. It didn't take neither the high nor the low. So that is a consolidation candle, right? So and you could see that the market finally went for it, right? So that is the basic thing that we are using, right? That is a basic thing that we are also using when our PD array or our point of interest get hit, right? When our point of interest get hit, we want to see this signature, right? Now focus on this signature. Do you get it? We want to see, we don't want this to happen at our point of interest. We want this to rather happen. So assuming that this example, when our point of interest got hit, right, which is also known as our PD array or our fair value gap, let's just assume that this C2 closed over this way instead of closing inside the range, right? If our C2 closed over this way, then based on what I just demonstrated to you, that is the market telling you that it's not willing to go down yet. Do you get it? Because if the market is willing to go down yet, then it will close inside the range. But in this scenario, it is closing outside. So in this scenario, what you have to do is you wait for more data. When you talk about more data, you wait for price to print, right? So assuming that the next day the third candle comes and then we form a strong down candle this way, and then we closed over the second candle this way, then that is the market telling you that it's willing to go down, and that's why it is closing over, right? Referring back to what I just demonstrated, that's what I'm trying to teach right now. Then if you allow more data, right, then the next day the market closes over this way, then you can, as long as your drawn liquidity is still intact, let's say this is your drawn liquidity, then the next day you can focus and trade, right, and then target the low of that third candle, right? So whenever you get a reversal candle that doesn't close inside the range of the first candle, then you should wait for the third candle to print, right? You should wait for more data, right? So now, whenever you don't get a closure inside this way and you get this closure, this is known as an imperfect closure, right? So during the course, when you hear me say imperfect closure, this is what I mean by imperfect closure. Do you get it? And when you get a closure inside the range of the first candle this way, then that is a perfect closure, right? Now, when you get a perfect closure, right? When you get the C2 candle closing inside the range of the C1 candle, then you can focus and trade the next day candle. And that next day candle will be your third candle, right? And what will you do? You will expect that next day to go down because you are bearish, right? Now, whatever I'm explaining for a bearish scenario can be applied to a bullish scenario, right? Just that a bullish scenario, it will turn upside down, right? So in this scenario, when price took this external range liquidity and went for this internal range liquidity, and then we had a perfect reversal closure, a perfect C2 closure, then the next day we can expect the next day candle to come for this low, right? Right? And we can also see that there is even a bullish FEG also over here. And as I explained in the beginning, if you forgotten, you can go back to the beginning. I said that when there is you are bearish, right? Let's say you are framing trade from internal to external, and there are bullish FEGs that can disrupt price. You should target them. And whenever you are trading, right, the easiest draw on liquidity is to target previous daily lows and highs. So in this scenario, the easiest draw on liquidity that price is going to get to will be this previous daily low. So let's see the third day, right? So you could clearly see that the third candle came and then it closed over, right? Now there is this FEG that is not fully disrespected yet. You can clearly see that the market didn't close over to turn this FEG into an inversion FEG. So what do? You will wait until the market disrespect that. Although we are closing over, right, which is telling you that the market is willing to go down, but you should know that there is this bullish FEG that is avoiding price from going down. So you have to wait. Do you get it? So let's see. So you can clearly see how the next day printed. You see, it didn't really go down. It didn't form a strong down close candle. When we talk about a strong candle, when we open this way and then we go lower, this is a strong candle. This is a strong candle. And then this is a reversal candle. You see, this is how a reversal candle form. And this is a bearish reversal candle. So know the difference. This is a bearish reversal candle. Do you get it? This is a bearish reversal candle. If it is bullish reversal candle, this is how a bullish reversal candle forms. This is how a bullish reversal candle forms. You can clearly see the lower part is longer than the upper part, right? So you can see we are still respecting this. Do you get it? So if we were to target this previous daily low or this FEG, and price just got there, we will take our profits. And you could see we made some profits, right? So right now, you don't, although you expect price to deliver lower, but you have to also listen to the story that the market is telling you, right? You can clearly see that the market hasn't still disrespected this bullish FEG. So let's allow more price action. And you can clearly see how it's turned price. And if you listen to what I just said, you would have saved yourself from hitting stop loss. You get it? So at this point, the markets that we expected to go lower, we just don't start trading targeting this external range liquidity. That doesn't make sense. You wait and listen to the story. You follow the story. If there is a bullish FG, you target that. You wait for it to get disrespected. If the market really wants to go down, it would have disrespected this FEG by forming this way over it. The market would have disrespected it this way. And then we can focus on trading the continuous candles, right? So right now, you don't know what the market is doing at this point. At this point right now, you don't know what the market wants to really do. So we can clearly see that we wanted the market to go down from here, right? Because the market is down providing fair value. And the market is down providing fair value. It will seek liquidity, right? So the market provided fair value over here. By balancing this imbalance, we wanted it to seek this liquidity. But the market said no. It's rather turned by reacting to this bullish FEG over here. Now, when we say that the market provides fair value and seek liquidity, right? This is liquidity. This is liquidity, right? This is external range liquidity. And I know you know what external range liquidity is. And this is external range liquidity too, because it's characterized by 3 candles, 1, 2, 3, a swing point, right? A swing point. Now, we expected the markets to react to that internal range liquidity and come down for this external range liquidity. The reason is because we were bearish on this price action. And the reason why we were bearish is because we realized that bearish PDRs are supporting price to go lower. So we were going for the odds that price should be bearish, right? The odds that price should be bearish was more than the odds that price should be bullish, right? So in a scenario where now price is down providing fair value, the next thing that is going to go for is liquidity. It can go for this liquidity. It can go for this liquidity. But because we are bearish, we want it to go down for this liquidity. So right now that the market is telling us otherwise, then if it is not willing to go down for this liquidity, then the next liquidity to go for will be this. Because right now the market is telling us that it's not willing to continue the bearish movement, right? It's not willing to go down. Do you get it? So if the market right now, the market is now providing fair value. So we wanted it to go for this liquidity, but rather it's saying no, I don't want to go for this liquidity. And looking at how it is turning and disrespecting this bearish FEG over here, I can tell you that the next liquidity the market will go for is this. And I can tell you at this point that the market is willing to change its direction. So let's see what will happen. So you could clearly see that we went for that liquidity. Now, looking at this, we can say that the market has turned bullish or willing to turn bullish. The reason is because the market first failed to move from this internal range liquidity to this bearish external range liquidity, and instead the market disrespected it with a bullish candle. And then apart from that too, we are forming this change in state of delivery, right? You see this series of down close candle took liquidity and then we closed over, right? So at this point, the market has taken external range liquidity. There is this internal range liquidity, which is this fair value gap. Another thing is there is this change in state of delivery over there, which is also an internal range liquidity, right? So at this point, the market can come down and then go up, right? because the market is done seeking liquidity. So the next thing it will do is to balance fair value gaps, or is to provide fair value. So let's see. So the market went up and it left another liquidity which it can read price to and move from there. So let's see what will happen. So you could clearly see that we came to this liquidity, right? We are reacting off this liquidity, right? And don't get confused. I said, right, the only time that we will start looking to trade from our point of interest is when we get a perfect C2 closure. And we could clearly see that we didn't get any perfect C2 closure. Now, anytime you're watching my videos, right, and you get confused or you don't get something, go back. You realize that I explained it. Go back, listen to it, and then come back and continue. Do you get it? Because the focus span of human beings is very short. So you can clearly see here we didn't get a perfect C2 closure. And at the beginning, what did I say? I said, if we don't get a perfect C2 closure when we tag our point of interest, what are we going to do? We are going to wait for the next day to print. So let's see. And when the next day printed, is this a strong bullish candle? No. If we talk about a strong bullish candle, we want to see something this way. This would have been strong. And it would even make more sense if it had printed strong and closed over this reversal candle this way. Right? Then that will be the market telling you that it wants to continue bullish. Do you get it? Yes. But here it's formed small. It doesn't make sense. Or if it was even to form a bearish reversal candle this way, then now it's also the market telling you that it wants to go up, right? So let's say we were to form this way. Then we can focus on trading the fourth day, right? Now this way, you can still base on this to trade the next candle. So you have to wait for more data. Allow the candle to print. Now looking at how this fourth candle printed by closing over this and also closing over this, we can base on this to trade the next candle, and then we target this previous daily high because we expect the market to move from internal range liquidity to this external range liquidity. Well, that next candle can even come for this external range liquidity. So let's see. So you can clearly see that we came for that, right? So this is where we are going to end today, and watch the video several times to understand everything that was taught in this video.